It is December 17th. Michael Vaughn with Brian Acker. Brian, we have some 5-year numbers here of the U.S. Value 50, and they're terrific.
20.2% compounded over the last 5 years, net of all fees and expenses. So, yeah, back in November of 2008 to 2013 of March, yes. Compounded by 20%.
So that's 400% roughly.
Yeah, a little less, but hey, I'm happy. So.
It shows the advantage of staying the course. I remember it wasn't easy sometimes. But
yeah, I had a whole lot of hands, but the process worked. It came through, and for those who certainly white-knuckled it throughout that period of time, it certainly paid off. So.
Well, the Canadian fund has similar performance. It's not quite the lights out of the U.S. fund, but the 5-year numbers of this are very good as well.
A little over 11% compounded after all fees and expenses. The Canadian market didn't go down as much as the U.S. market. We were at a lower valuation back in 2007, 2008, but still 11%, right along with the index. I'm pretty happy with that.
Well, let's talk about the U.S. some more, because the talk now, or the great black cloud, is tapering, the quantitative easing and so on. Does that have an impact?
I think psychologically it does, but that's about it. So, yeah, we had a jobs number beginning of the month, 207,000, and everyone's going crazy with
the good old days.
Yeah, the good old days, 400,000 plus, and for the Fed to even to signal a little bit of tightening here, I think is way too much in terms of economic performance. If they're claiming economic performance, this is not the number to boast about, I assure you. So whether they do or not, it's up to them. But what you want to get is the U.S. economy getting to at least what we call launch speed. You know, trying to make sure it goes for at least 3 to 5 years under its own weight, and obviously there has to be a process.
Closing down and putting an anchor on the economy the way it was last year.
That fiscal drag this year took about 1.5 to 2% of GDP out of this market. So there was a budget deal just a week ago, which lasted a day and a half on the media. But what they did was, for those people who know the numbers, the sequestration would have dragged the economy next year, 2014, by probably about 0.5% of GDP.
But that's off the table now.
This budget deal eliminates that. They found, common sense ruled that this is crazy, and putting money back into programs that were cut certainly at the beginning of the year. So that was the budget deal that was cut.
Then what? Excuse me. What does that make your outlook for 2014? Can it be as good as 2013?
There is potential. I think it's double digits. I mean, but I think January, February has a real chance of, depending upon what the Fed does. I think asset allocation models, etc., and you see it more and more. Analysts are now getting bullish on the U.S. You can see money flows going into the U.S. market, and also the U.S. dollar, which has been our theme now for quite some time. So have those money flows go in, etc. The first part of the year, I think, is going to be quite good, but we'll see what happens in the economy, what happens in the summer, and obviously the fall of 2014. So.
One last question. The U.S. Value 50, when you're measured against the other U.S. equity funds, where did you stand? I think you're about 1,100.
1,100 mutual funds, and we were number 2 in the 5-year return category. So, yeah, we did, it was lights out in terms of performance, and hopefully this is the start of better things for the next 5 years, for sure.
Great for the last 5. Brian, always a pleasure seeing you. Congratulations on 2013. Merry Christmas, happy holidays. See you next year.
Same to you, Michael. Very good to see you again.